Hey guys, welcome to another episode of 21st Capital. Today is January 16th, 2025, and I have the pleasure of having Dan Hillary with us, who has been an analyst, very smart analyst on that I got to know on Twitter, on Bitcoin Twitter. He's been very productive educating folks about MicroStrategy and options. And today we're going to talk about how to structure MicroStrategy's options, especially how to decide and how to intelligently think about the parameters, option Greeks, expirations, which options have a better risk reward profile, and so on. How he thinks about it, how he strategizes them. Welcome, Dan. How are you?
Hey, Sina. Thanks for having me. Yeah, I'm really excited to get into this today because I learned something by making these posts, which I always love. Then also, different options can be used in different ways. And I really think that's super interesting and something people don't talk about. They think every option is the same, but, options have different utility, in my opinion.
Yes, and the reason people need to understand options, even if you don't exercise them, it's good to learn about them because they allow you more latitude. If you're interested in Bitcoin, you can buy it and you can go long indefinitely. That's perfectly valid. But if you understand options, you can do other things with them. Perhaps make bets that allow you to safely and with very well defined downside bet on the upside, or maybe in other cases when you fear that the market might turn. Options might give you an opportunity to not sell your Bitcoin and instead maybe sell the upside, generate some cash flow to avoid selling your stack. So there are many extra things they allow you to do, or at least you can insure your stack if you worry about it, right? So a lot of people, when Bitcoin price goes higher, they worry about saving those profits. They worry about one of those brutal downturns. Options allow you, for example, to insure it so that you can leave your stack there and also have some insurance against it, which will be a lot more tax efficient. Just one example, but there's many more examples, many more complex strategies you can exercise, you can implement with options. It's a really good thing to understand if you hold a lot of an asset. So today we're particularly talk about MicroStrategy and try to focus or structure the discussion around a beautiful post that Dan had put out on Twitter explaining multiple, the way he looks at it, different options and the expirations and how he looks at option Greeks. This session will also allow us to understand the option Greeks and how each of them matters for different things. So this should be a very, very helpful and educational session. I'm excited, looking forward. So I'm going to have Dan pull up his tweet, and let's take it from there and review that.
Thanks, Sina. Yeah. So my goal here was just to explore some of the different options, expiries in the next 6 months. So there's a February expiration, March expiration, April expiration, and a June expiration that I wanted to look at. And what I'm comparing are the different option Greeks for different strikes. So maybe a quick refresher on option Greeks. So I use 4, so 3 first order and 1 second order option Greek. Vega is the sensitivity of an options price relative to the implied volatility of MicroStrategy. Delta will refer to the change in an options price based on the change in MicroStrategy's price. Gamma is the second derivative of price with respect to time. So it's the change of delta with respect to price. So let's say, for example, the price of MicroStrategy is going up. The delta, or the rate of change of the price of the option relative to MicroStrategy's increase, might go up, and that's represented by gamma, or it might go down. And then theta finally is something a lot of people are familiar with and talk about a lot, which is just the time decay relative to an options price and its time to expiration. So that's kind of that's the terminology. If you need to rewind and look at those again, please do. They're important to understand. They're not that complicated. They just have fancy words.
Yeah, but so basically the value of the option changes as a function of many other parameters. As time changes, value of the option changes. As the underlying asset changes in price, option value changes. Similarly, when the implied volatility changes, same thing. All these option Greeks allow us to quantify the strength of those relationships.
Exactly. And so what's interesting about these different expiration dates is obviously, theta will be different, but you can look at these different Greeks at different strike prices. So what these charts, which they seem a little, complicated or confusing at first, all they're doing is, so we're looking at a constant snapshot of a single expiration. In this case, it's the February 21st expiration. Is it the February 20th? Yeah, February 21st expiration. And we're looking at a single Greek. And so in this case, let's do something like theta. So theta, again, is the time decay of the option contract. And you can see these are the different
Quick
strikes.
question.
Yeah.
Where can people see it? Is it live or is it something you calculated yourself?
No, this is options market data. I'll add a link somewhere. Maybe I have it at the end here. Yeah, it's called optionsmarketdata.com or something like that. Let me add it. I'll comment it in this video, and so everyone can go and view these charts.
Perfect.
But yeah, so looking at theta, and so theta is time decay, right? And theta tends to be negative. And what negative means, or it's always negative. Negative means that as you get closer to expiration, the value of your contracts will, with all things being equal, all things non-changing, they'll decrease, right? Because most option contracts that are out of the money in particular, and even in the money, have a time value premium. So that's what theta represents. And when it drops down to this low value here, right, you can see that theta is eroding at the fastest possible rate for contracts that are just a little bit out of the money. And MicroStrategy at the time, which is a couple days ago, was trading at $330 a share. And so you can see that theta is extremely high for these at the money contracts, all things being equal, based on the other pricing factors. And so that's something to consider, right? If you were to buy one of these 400 strike for February, you have the highest rate of decay based on time to expiration of any of the contracts we're looking at. So that's kind of an intuitive fact, but something you need to understand. Then, do you have anything else to say on theta?
So maybe just to clarify for folks, as when you buy a call, if the asset doesn't reach the strike price, you get zero. If it does and exceeds your premium, you get a profit. As time goes by, the chances of all these happening changes. So every day you might find yourself in a position, if you bought a call, for example, and paid $10,000 for it, you might find yourself in a position that every day you are losing quite a bit of money as the value of that option goes down. So it's really, and it's not linear. So, and it's also a function of the strike and the time. So it's really important to understand where you stand on that theta spectrum and position yourself in a way that you are not losing a lot of money day by day just by waiting. Actually, it's much better to be on the other side of that.
Exactly. And I think that, and a lot of questions I get are like, okay, let's say I have a option contract expiring on February 21st with a 450 strike. And a lot of people ask, should I hold it? Right. And all this graph tells you is that, well, this thing is decaying rapidly every day. The value of one contract will drop by 0.6 for every day that passes. So you need to make a decision here. Do you want to hold it? And we can talk a little bit more. Are you betting on a near-term move? If you're not betting on a near-term move, a big jump to the upside, then all you're doing by continuing to hold that contract is just eroding its value for the next month or so. So just something people need to consider.
What was MicroStrategy price when you posted this?
It was $330 a share. So these red lines here indicate the current price.
Oh, that's it. Okay. Perfect.
It's hard to discern, but you can see it.
So even when you buy in money, right, some of the premium hidden in it comes from the expected profit in the future. So the more time passes, that expected extra profit also compresses. So even if it's in the money, it shrinks back to intrinsic value.
Exactly. Yeah, so you have to be really careful. And even if your options are deep in the money or somewhat deep in the money, let's say you're holding a 200 strike option that's in the money for February, there's an extrinsic value associated with it, and that's what's being eroded by the theta decay here. So something to think about, something to consider. If it's in a tax deferred account, I would definitely sell something like that, right? I would never. If you have an in the money option contract that's going to expire in a month or even 2 months, and you're in a tax deferred account, it makes a lot of sense to just unload that and then go into spot holdings, because you're taking on a lot of risk there coming up to the expiration date.
Perfect.
We could talk about delta now. And so delta is the most important, I think the most fundamental metric. And delta is simply the rate of change of the options price based on a $1 move in the underlying, with all else being equal. So you can look here and you can see that this is a bit confusing too, because an options, one contract represents 100 shares, right? So these deep in the money contracts here move on par with the 100 shares that they represent. And that's what a delta 1 means. So a deep in the money call acts like stock, means it has a delta of 1. And now you may say, but when MicroStrategy does a 20% move up, my options contracts that are at $450 a share with a $450 strike will do like a 40 or 50% increase in the nominal value of the call option. That doesn't mean, delta doesn't mean the percentage move of the option relative to the underlying percentage daily gain, right? It's relative to to 100 shares of the underlying's daily gain, because these option contracts represent a leveraged claim, or a claim over 100 shares. And so that's something important to consider. Perfect. Did I make that clear enough, Sina? Yeah. So delta again is just the rate of change it's the change in price of the option relative to the $1 change of the underlying. And we might as well hop into gamma right then. So gamma is the rate of change of delta relative to the underlying. And this is really important. It's kind of like the concave, or like I know a lot of people, they do calculus, and you know what a second derivative is. Gamma is just a second derivative, and you can see that the gamma is extremely high. It's very, very high for options contracts that are right at the money. And so that means the delta is changing rapidly, and those contracts are most sensitive to price movements in the underlying. And so what I concluded, and what a lot of people use these kind of shorter term 1 month, 2 month contracts to represent, are short term moves in the underlying. So if you think MicroStrategy is going to rip next week, you'd want a shorter term contract with a really high gamma that exposes you. You have extreme exposure to the movements in the underlying price. However, by taking that sort of leverage, you also now have extreme exposure to the theta, the time decay, which is working against you while the gamma is working for you. So that's why I kind of set forth the idea that short-term price movements, spikes or dips, you're using kind of shorter-term options to bet on the gamma and delta, and kind of you're taking on the risk of the time decay.
Yeah, so basically intuitively, if the price is at 400 and then your strike is at 1,000, a few dollars change in the price of the asset doesn't really change the likelihood of getting to the strike price. So that's why you get a slow change. But if you are very close to the strike, it's going to matter a lot whether you are on this side of it or on the other side of it by the expiration. So your fortune will change by a few dollars of move. So that's why your gamma is maximized, showing the highest sensitivity.
Exactly. And I don't even have charts of shorter term options, but this is only heightened for options that expire in 1 week, 2 weeks, 3 weeks. Like if you want to bet on a price movement tomorrow, a at the money contract expiring next Friday may be your best bet. So you can use them in many different ways. That's not how I tend to use them at all, but some people like to do it. Now this is a March expiration, very similar to the February. You've got 2 months, so your theta is a little bit, your time decay at the money is a little bit better. So it's 0.5 as opposed to minus 0.6. It's minus 0.5 as opposed to minus 0.6 at the money strikes. So your time decay is still very rapid and anywhere between 30 to 45 days expiration. In this case, it's a little bit more than 45 days expiration. You're really getting hammered with this theta decay. But with the increase in theta decay, you get an increase in gamma at the strike. Same deal. You have a really high gamma, not as high as the Februaries, but right out of the money, close to the money. You have a really high rate of change of the price of the option contracts relative to the underlying. So again, this is kind of a leveraged 1 month play with a higher gamma, a little bit more theta resistance. And then one thing we should probably talk about is Vega. And Vega is a really interesting Greek that most people don't consider when they think about traditional equities. The interesting thing about Bitcoin is the volatility of the underlying goes up as the price goes up, and that's not seen really in any other sort of traditional equity. Microstrategy is much the same. So a lot of people have been able to make a lot of money on these option contracts simply because as the price of Microstrategy has gone up, the implied volatility has gone up. We can look at that chart real quick right here. So you can see the spikes in implied volatility here. This is implied volatility, not price, but they correspond with an increase in price. And so you have all these factors working with you during these peaks where the implied volatility is going up. So Vega says that the price of the options contract will increase with the increase in implied volatility because there's a higher chance it will finish in the money or farther in the money. And then you've got the gamma and the delta working with you. So as all these option contracts come to at the money and into the money during one of these run-ups, these option contracts really work in your favor simply because the implied volatility increases with the price of the underlying, which is an interesting and unique sort of dynamic for MicroStrategy and Bitcoin.
And it makes it more likely that it's not priced in, essentially.
Exactly.
Especially when you have non-linearity, it's if you understand it, you have an edge over the market.
Exactly. And I think that's a good point to reference. A lot of people talk about like priced in. Isn't this all priced in? Isn't the probabilities priced in? I mean, like not necessarily, right? You can see this equity changes before the 24 or the 42, the 24, sorry, 21 plan and the 42 plan. We didn't understand MicroStrategies necessarily grand strategies. There's no way that was priced in. We didn't know the ATM would be so aggressive. We didn't know the implied volatility would spike with the hype around the red sweep. So like there are all these different factors that do change, and you can bet on changes, and that's what these option contracts allow you to do. Is you're betting on changes in the market, and there's some really good computer algorithms that determine probabilities out there, but no one knows deterministically what's going to happen in the future. So if you want a asymmetric upside bet, options contracts can do that for you.
Exactly.
Now we've got April expirations here. You see the gamma is quite a bit lower, and the tail is a lot farther out. So same with the theta and the delta. So the gamma being sort of flattened is really, really important. And this is why I tend to sort of steer towards these options contracts and look farther out of the money. So I believe that people underestimate what will happen in the long term and overestimate what will happen in the short term. So if you're one of those kind of believers, you want to bet sort of that, or I've always wanted to bet that MicroStrategy will outperform over long amounts of time. And so you want a contract that's very sensitive to movements it gives you a lot of time and has sensitivity to movements that are, non-consensus views to the upside. And so longer term contracts that are farther out of the money have always been able to do that for me. And as you can see, the gamma flattening and the sensitivity to change farther up on the strike scale, you're more exposed to bigger movements, and you capture still a lot of the short-term upside. So Vega is also it's even higher for these longer-term contracts, and that's a really interesting dynamic. So you've got these contracts that are far deep out of the money, farther to expiration, but you have this still really, really high sensitivity to change in implied vol. So even if you get a big spike in price and your contract wasn't necessarily perfectly tuned to time that spike in price, you receive all the benefits of the upside and the increase in implied vol, even with these longer term contracts, and you can go to sell if you want. So again, the Vega is very high still for far out of the money and long to expiry contracts, makes it very attractive for people looking to sort of limit their risk. I think you have to be pretty on your game to be purchasing short-term MicroStrategy contracts. I think longer term, for the reasons of Vega being high, is a much safer bet.
Do you have the theta for this one?
Yeah, Theta 0.4. So a lot
Yeah.
lower, right? A lot lower than the
Yeah, yeah.
0.6 you're seeing. Yeah.
Exactly. But kind of summarizing what you said, it kind of gives you a trifecta of positivity. If the asset price, if MicroStrategy goes higher, you you have an exposure to the underlying, so that goes up. But because of gamma, you don't get a fixed effect. So the higher MicroStrategy goes, the sensitivity actually goes higher. So you sort of get a double benefit as MicroStrategy goes up. Plus, when that happens, it becomes more volatile. So you get a benefit from volatility. So you have three factors that work for you on the upside, and only it makes it very difficult for the average participant in these markets to price these in. So when you kind of have everything aligned, there's a very good chance that you get a fantastic asymmetric bet.
Exactly. Yeah, and obviously it's a bet, right? And when we're talking about probabilities and risks, and so when we go into these contracts, we're thinking, okay, we're taking a bet that may finish, to zero, but we justify it or make the decisions based on the fact that look at all of these factors that will make this payoff extremely high. And Sina put it really well. Now, finally, I looked at the June 17th. So you can see gamma is about half what it was before. So the sensitivity, the rate of change in the underlying is it's not very sensitive, right? So the second derivative of price with time is quite low. So these aren't going to move as aggressively with moves in price. However, you are going to see, larger gains for sustained outsized moves to the upside. So they're less sensitive in the short term to price movements. However, over a long period of time, you've hedged your time risk by looking at we can look at theta. So theta is about 0.3. So you're a lot safer here necessarily, or you have more time to expiry. So you can hold these and bet on longer term moves. You're not as sensitive to short term movements. These are more of a directional bet. And so I think the longer out, like especially leap contracts, it's just a different bet than the short term contracts. Right? The short term contracts are kind of like perpetual futures in a way. Whereas these long-term contracts are more like equity, in my opinion, because you're buying a right that changes with the dynamics of the equity over time. So I think someone said it really well that like these option contracts have become since 2000 when options really started becoming popularized in the U.S. equities markets. They're an extension of the equity price itself. You can't just only look at the equity price anymore. You have to look at both the equity price and the options chain, both the puts and the calls out to different expirations to understand how the market's pricing this thing moving forward.
Perfect.
Vega here again. That's the other really interesting thing is like, so you've got this call option that's less sensitive to slight movements in the price and in the short term. However, it's still equally as sensitive to changes in implied vol. That's why I think it's such a much safer bet going farther out because you still have all this IV sensitivity, and that IV really can help you during these price spikes. And that's how most of these options guys have had such crazy returns is because the IV is kind of is piggybacking our directional positioning.
Yeah, one of the great things that your charts show is that it gives you a great compass into is it a good time to buy options? Is it already too expensive? Am I late? Well, you can look at the Greeks, and you can look at your risk profile and the premium you're paying, and this will help you make a decision a lot better. Are you buying right now as well, or at least in these periods, or is it like you have built a position previously and you're just letting it play out?
Yeah, I would be a buyer. I would have been a buyer the past couple of weeks, but I'm not. Well, one, they're a lot more expensive than they were in the fall. I don't think it's nearly as good a buy, even though the implied vol is much lower, and we can see that based on this market chameleon chart. You can see the implied vol is almost down to where it was in September. The skew in the options market is much higher though. So the implied vol of those farther dated contracts are higher than they were in the fall. So I don't think this is as good an entry as it was for the same current realized volatility. So I'm not a buyer, but I also have no cash to buy. So I'm just holding through this kind of downturn.
And sometimes when they are very expensive, I go the other way. I sell short term, and but mostly in Bitcoin, I bid, because I can have a model that helps me get a sense of the possible weekly movements, or at least a histogram of possibilities on a weekly or bi-weekly basis. And when options are very expensive, well, I don't have to bet on the upside. I can bet on, I can essentially generate cash flow from selling calls. And the way I would think about it is I'm selling the upside with an expiration. So let's say today the price is at whatever. Let's say a few days ago where I had an example posted. Price was at 95, and I made a bet that okay, within a few weeks we won't go as high as 110. Okay, that was a very safe bet. I think 105 or 10. That was a very safe bet because it was very unlikely to happen. But if it did happen, it was still a great bet because that would mean my main stack has gone up. So my analysis was saying, okay, it's not likely for Bitcoin to explode as much, and especially this makes more sense when the market has already gone up a lot and you're feeling some downside risk. Then you can collect a premium. Otherwise, an analysis like this allows you to go long by calls at an opportune time when the market is not really pricing in all the convexity and all the compounded benefits that comes from gamma exposure and implied vol exposure. And you have a thesis that the underlying will grow, and as it grows, a lot of extra positivity happens for it, better volatility, better sensitivity, and you still you have a lot of time as well, so you minimize your theta exposure, and that combination gives you a wonderful bet. Like you said, nothing is guaranteed, but when your upside is much higher than the downside, that makes it a great use of your cash. And another wonderful thing with options is you're using a small amount of cash to bet on a much larger outcome. So it's much more cash efficient, capital efficient, but more analysis heavy.
Exactly. I think it's a really good way to put it. And I love your sort of the way you explained selling the upside. And that's exactly what a covered call or a covered call on a portion of your position is. And it's a thing most people don't think about. Whatever sort of understanding you have or thesis you have surrounding price movements in the market, you can express using options. You can sell short dated, you can buy long dated, you can buy short dated. So, the world's kind of your oyster. It's just you're only limited by your creativity and your and how right you are.
Exactly. For instance, you can say something like, I want to bet that Microstrategy will go up somewhere between 400 to 1,000. So you can sell the upside above 1,000 and collect some cash today. Use that cash towards buying the call option for 400 strike. So that gives you exposure to all the positive gains from 400 to 1,000, but no exposure to anything beyond that, because your analysis says that's unlikely or whatever thesis you have, and that lowers your premium. So you can even invest in the 400 to 1,000 upside with much lower cash. So this is what kind of excites me. It might be too complicated for a casual observer, but the flexibility it gives you is very exciting. You put it very well. You can express your views exactly like you said in however you want. It's very, very flexible. And like I said, for people who hold a lot of Bitcoin, it also allows them flexibility in multiple ways. If you can express your fears and your expectations, you don't have to. You are not locked into selling your Bitcoin all the time whenever you need cash or whenever you fear something in the market. Or when you need, I mean, I was just talking to someone who had a large amount of Bitcoin, but then a cash flow issue. That's actually most people's, if you're very successful, that's where you will be. You will have a lot of assets, and your wage or consistent income would not necessarily be, comparably as high. So what do you do? Well, you can sell your Bitcoin little by little, or sometimes you can sell only the upside of the Bitcoin, not the Bitcoin itself. And this to me seems like a fantastic option to have. Just that's why I said just even understanding these without necessarily exercising them or being in a trade is wonderful. And I also know a lot of people who plan on quote unquote selling at the top, which is, I still haven't seen a person who successfully and consistently predicts short-term moves. But if for whatever reason, let's say you have an expense 3 months later, maybe, I don't know, 6 months later, and you worry that you have the money right now, it's in Bitcoin, but you worry that price fluctuation might drop the value over your investment. So you might be pushed to sell today to guarantee having funds 6 months later. Learning some about options allows you to say buy a put option in this case, which wasn't the topic of our conversation today, and guarantee that your downside is protected. So yeah, I guess this is a very interesting idea. And right now, what's extra helpful is all this is regulated. There's no minimal. I shouldn't say no, but minimal risk of a rug pull. Right? You have recourse if you were making these bets on the monkey.com website, then you would be exposing yourself to a lot of risk, a lot of counterparty risk. But when these things are managed by Fidelity, Vanguard, and not Vanguard, but other ones, highly regulated, insured institutions, your capital and your investment is also protected. So risks are a lot lower. Well, thanks a lot, Dan. This was a fantastic introduction. I hope people got value out of this. Maybe tell us a little bit actually about what's coming in the future with you regarding your option strategy. So you have built a position, you feel that it's not as great of a trade right now for the particular strategies that you're looking at. What would be your thoughts moving forward? I saw a post you made a few days back, and I think I was watching your video explanation, and you were mentioning some thoughts related to selling early, right? And not wanting to catch the downside of MicroStrategy if it happens, like if we peak at some point to a really high level and then Bitcoin wants to come back down and take a nice pause, enter a bear market, then the other side of the bet is very, very risky, right?
Yeah, I think I definitely talk a lot about that. I just don't want to ride the backside or a potential bear market down with options. So I'm a big, my next step, I have a lot of in the money contracts, which I'll be looking to exercise. I'll be looking to sell excess volatility. Let's be a little more conservative. I've been kind of YOLO long for the summer and the entirety of this year, but the things are playing out the way, I hoped and other people hoped. And, you have to take your foot off the gas at some point.
Yeah. So it's very important that many people begin playing with instruments that allow them leverage, and they make a lot of money, but it's on paper. It's important to keep, vigilant, and most importantly, understand before you act, educate yourself, and don't take too much risk, especially risk that's more than your knowledge. So, and consider that all the positive gain that you might benefit from can also happen on the other side, right? Options also give you leverage to the other side, although they cap your losses, which is a wonderful outcome, but at least your gains could be at risk if we get a slowdown, or not, or even if the volatility goes down, like the market becomes boring, you might keep losing quite a bit in the options as well, not just because of the asset price drop. So keep that in mind. Well, I hope you got value. Some disclaimer, probably should have done this in the first second, but not investment advice. Talk to your investment advisor before making any decision. This is only for educational purposes. With that, I thank Dan. Fantastic education. Thank you very much. Generously explained to us his thoughts and knowledge. And thanks again. I hope to see you again sometime soon.
Talk soon, Sina. Thanks.
Bye-bye.